Understanding the intricacies of step cost and cost curves in manufacturing is like unlocking a treasure chest of insights that can significantly impact a business's bottom line. Imagine being a captain navigating the turbulent seas of production and profitability. You need a reliable map, and that's precisely what cost accounting provides. It allows manufacturers to chart their course through the complex waters of cost, helping them identify key cost drivers and make informed decisions about pricing and production. So, what are step costs? Think of them as the stair steps of your production journey. These costs remain constant over a specific range of activity levels, like a flat stretch of road, but once you hit a threshold, they jump up to a new level. This can be a bit tricky because it means that a small increase in production could lead to a significant increase in costs. For instance, if you can produce 10,000 widgets in a single shift, but then you get a surge in orders, you might have to add another shift and hire a new supervisor. Suddenly, your costs have stepped up. Understanding these step costs is crucial for maintaining profitability, especially when demand fluctuates. Now, let's break this down further. When a company's activity level decreases, it's vital to be aware of step costs to avoid unnecessary expenses. This might involve tough decisions, like laying off employees or selling off equipment. But sometimes companies can postpone these step costs by implementing production efficiencies or offering overtime to existing employees instead of hiring new ones. It's all about balancing the scales of cost and productivity. Best practices for managing step costs involve clearly defining the activity levels at which these costs will be incurred. This foresight allows management to plan operations strategically, avoiding unnecessary costs for as long as possible. It's like preparing for a storm. If you know it's coming, you can batten down the hatches in advance. Let's look at some real-world examples of step costs. Imagine a facility that can operate efficiently until it needs to expand its floor space. The costs remain constant until you build the extra square footage, and then they jump up to accommodate the new expenses for maintenance, heating, and insurance. Or consider a factory that requires a minimum of 10 employees. Their wages remain constant until the production demands exceed that number, at which point the labor costs double overnight. This sudden leap can catch businesses off guard if they're not prepared. Optimizing step costs in manufacturing brings a plethora of benefits. First off, it can lead to reduced overall costs. By identifying areas where expenses can be minimized, businesses can enhance their profitability. Increased efficiency is another perk. When processes are streamlined, production times decrease, leading to higher output. Better product quality often follows suit, as companies can correct inefficiencies and ensure they deliver the best to their customers. Moreover, companies that master step costs gain a competitive edge. By reducing costs, they can offer more attractive pricing, capturing a larger market share. This flexibility is crucial in today's fast-paced marketplace, allowing businesses to adapt quickly to changes in demand or supply chain disruptions. Now, let's dive into the different types of step costs. Discrete step costs are like sudden jumps, remaining constant until production levels rise beyond a certain point. Continuous step costs, on the other hand, increase gradually. Think of how energy costs rise as machinery is used more frequently. Committed step costs are those that can't be easily reduced, often tied to capital investments, while discretionary step costs are more flexible and can be adjusted based on business needs. Understanding the relationship between step costs and cost curves is essential. A cost curve visually represents how costs change with varying output levels. When step costs are factored into this curve, you get a series of straight lines with abrupt jumps at the points where costs increase. This visualization helps businesses predict how costs will fluctuate in response to production changes, allowing for more strategic decision making. So, what are cost curves? They're graphical representations that map a company's costs against its output levels. The total cost curve shows how total costs change as output increases or decreases, helping companies determine the optimal production level for maximizing profits. The marginal cost curve indicates the additional cost incurred for producing one more unit, guiding firms on the most cost-effective production levels. Understanding curve costs can lead to significant cost savings. Businesses can adopt efficient production methods, leading to lower costs per unit and increased profit margins. It also aids in strategic pricing decisions, enabling companies to set prices that reflect their production costs while remaining competitive in the market. But interpreting the cost curve isn't without its challenges. Common errors include improper cost allocation, misunderstanding economies of scale, and misinterpreting average versus marginal costs. Ignoring externalities can also lead to underestimating actual costs, resulting in poor decision making. Who's responsible for interpreting these cost curves? Typically, it falls to the management team, financial analysts, and cost accountants. They work together to analyze cost data and make informed decisions that impact the overall cost structure of the business. Now, let's talk about how curve costs can help business owners reduce their manufacturing costs. Understanding the cost-volume-profit relationship allows owners to identify the production level at which profits begin to materialize. It also helps determine the break-even point, guiding entrepreneurs to reduce costs below that level for profitability. In addition, curve costs help estimate required sales volumes to meet profit goals and make strategic pricing decisions. Efficient resource planning becomes easier when data from curve costs highlights inefficiencies in the production process. However, misconceptions about cost curves can cloud judgment. For instance, many believe that cost curves always slope downward, but this isn't the case. There are often points of diminishing returns where costs rise faster than production levels increase. Additionally, the notion that cost curves are static ignores the fact that they can shift due to changes in technology, supply and demand, or regulations. Understanding the cost curve is paramount when making profit projections. It helps identify break-even points, facilitates effective cost management, determines optimal production levels, and ultimately enhances business strategy. In conclusion, mastering step costs and cost curves is not just a matter of accounting, it's about steering your business toward profitability and efficiency. By investing the resources needed to monitor costs accurately and develop strategies that align with overall goals, manufacturers can thrive in a competitive landscape. So, whether you're a seasoned manager or just starting, grasping these concepts will empower you to make informed decisions that propel your business forward.